How can you lose money with a straddle? Have you ever wondered how you could lose money using a straddle strategy in options trading? Let's break it down in a simple way. A straddle involves buying both a call option and a put option on the same stock, with the same strike price and expiration date. This strategy is typically used when you expect significant price movement but are unsure of the direction. When you buy a straddle, you pay premiums for both options. Your total cost is the sum of these premiums. To make a profit, the stock price needs to move enough in either direction to cover these costs. If the stock price does not move significantly, the options will lose value as time passes. This loss of value over time is known as time decay. If the stock price stays close to the strike price, both options may expire worthless, resulting in a total loss of the amount you paid for the straddle. Now let's consider selling a straddle. When you sell a straddle, you collect the premiums from selling both the call and the put options. However, this comes with much higher risk. If the stock price moves significantly in either direction, you may have to pay out much more than you received in premiums. This can lead to substantial losses, especially if the price moves sharply beyond the strike price. Selling straddles is riskier than buying them because your potential loss can be unlimited if the stock price moves far enough. In the context of stock price movement prediction, using a straddle means you are betting on volatility rather than the direction of the price. If you expect a big move but the stock remains flat, you can lose money on a long straddle. Conversely, if you expect the stock to stay flat but it moves sharply, you can lose money on a short straddle. Traders often use straddles around events like earnings reports, where large price swings are possible but the direction is uncertain. If the event does not trigger a large move, or if the market anticipates more volatility than actually occurs, straddle buyers can lose money. On the flip side, sellers can incur losses if the event causes a much larger move than expected. To sum it up, you can lose money with a straddle if the stock price does not move enough to cover your costs when buying, or if it moves too much beyond your expectations when selling. Understanding market conditions and managing risk are essential when using this strategy.